10. Expand your reach. Design your plan with an end in mind. Begin with the end in mind. Stephen Covey. In this chapter, you will see how many business owners create a family business legacy plan that is fair and equitable. It should be noted that fair and equitable does not necessarily mean equal. While something close to equal is often the result, depending on the circumstances, the division may be unequal, depending on the contribution of each of the family members. However, many parents want their children to be treated equally when it comes to family business planning. Parents who are concerned about family harmony are wise to address the issues of estate equalization as a key element of their estate and business planning. Most of the problems that would create disharmony in their children can be handled with careful thought and with wills, trusts, and business agreements that dictate the legacy plan. An important step in a family business legacy plan is to have family meetings to discuss the plans, answer questions from all sides, and reinforce the reasons and strategy behind the planning. In this chapter, we are going to talk about wills, trusts, and agreements available to create a family business legacy plan, and the use of life insurance to accommodate children who have physical or mental disabilities, addictions, or other self-destructive behavior. The insurance is used to create liquidity for any remaining estate assets and to create a legacy for children with disabilities. It is important for the business owner to consult with a legal expert in her jurisdiction before creating a testamentary trust will for a disabled child, so as not to disqualify such a child from any government grants or benefits. A testamentary trust can be used effectively when one or more members of the family warrant special consideration and/or when the beneficiary is not old enough to legally own property and/or not equipped to control or manage the inheritance responsibly. A testamentary trust arises upon the death of the testator, and which is specified in his or her will. A will may contain more than one testamentary trust and may address all or any portion of the estate. Testamentary trusts are distinguished from inter vivos trusts, which are created during the settler's lifetime. A business owner can also set up a charitable trust to enable the trustees to make tax-free donations to an eligible school, church, charity, etc. A charitable trust is an irrevocable trust established for charitable purposes, and the trust enjoys a varying degree of tax benefits. When considering life insurance to equalize the estates, there are basically two types of life insurance policies: whole life and term insurance. Whole life insurance is typically more expensive than term life policies, but the premium amount typically does not change throughout the life of the policy. Over time, this helps make whole life insurance more affordable. The payout your beneficiary receives if you die during the coverage period is typically tax-free and has a steady value throughout the life of the policy. If you need to, you can renew your policy when it ends. The premiums can be a bit higher. If needed, you may be able to access your money through loans for an additional charge. You can customize a whole life insurance policy with a variety of riders for an additional charge. Term insurance is a good option if you want to pay for life insurance during the time when the need is greatest. For example, when your kids are younger or while you are paying a mortgage. Term life insurance is available in 10-year, 15-year, 20-year, or 30-year terms and is renewable annually. A term policy can be converted to a permanent life insurance policy at the end of the term. The benefits of term insurance include guaranteed level premium remains stable for the duration of the term, and the payout your beneficiary receives if you die during the coverage period is typically tax-free and has a steady value throughout the life of the policy. A key step in purchasing a life insurance policy is choosing your life insurance beneficiary, the person or entity who will receive the cash benefit from your policy after you die. A beneficiary can be 1, 2, or more people, a trust you have set up with the proceeds administered by a trustee, a charity, or your estate. When you designate beneficiaries, you have the final say over who receives your death benefit. If you do not choose one, your state's laws determine who gets it and who wants to let their loved ones fend for themselves against a state bureaucracy. The primary beneficiary is first in line to receive your death benefit. If the primary beneficiary dies before you, a secondary or contingent beneficiary is the next in line. Some people also designate a final beneficiary in the event the primary and secondary beneficiaries die before they do. Some of the questions you will want to consider are: who will need extra money when you pass away? Are there people who depend on you for financial support? Are there people who will bear certain expenses at your death? Who receives the proceeds if none of your beneficiaries survive you? Should the assets pass to your estate? Would the assets be better off in a trust? With most policies, you can change your beneficiaries at any time. Review your policies regularly, and don't forget to make appropriate changes when your life changes, such as when you get married, have a baby, etc. You do not have to figure all this out by yourself. Contact your investment professional today to discuss your specific needs. Universal life insurance provides permanent life insurance protection and access to tax-deferred cash values. Coverage continues for your entire life. No need to renew the policy with higher premiums. Some universal life policies can build cash value that you can access while you're alive. Because situations change, universal life insurance allows for some flexibility. As long as you remain within set boundaries, you can change the protection level of the policy and decide how frequently you pay your premium. As with most permanent life insurance, the death benefit paid to your beneficiaries is not subject to income taxes. Likewise, the cash value you withdraw from your policy to supplement your retirement is tax-free. A special combination of universal life insurance and long-term care coverage, sometimes called a hybrid life product, can provide cash value to help cover long-term care expenses. It also serves as a life insurance policy providing a death benefit to your beneficiaries. The major advantage of UL is flexibility. You can change the protection level of the policy, and you control the amount of frequency of payments. This life insurance offers protection for your family and strategizes for leaving a legacy to them. It can also help small business owners with continuation planning. Variable universal life insurance is a permanent insurance policy that allows the ability to accumulate cash value while providing variety and control over professionally managed investment options. You have the freedom to monitor and make decisions on where to allocate your funds over time. This product also provides flexible premiums and flexible death benefits. It builds additional cash value that you can access, and earnings can grow income tax-free, which allows them to accumulate faster. Some of the disadvantages of life insurance include fixed periods of coverage. Most life insurance only covers individuals for a limited period. Many policies last for only 1 year or for 5-year increments up to 30 years. However, options to renew the policies are often available. Old age or poor health can turn the flexibility of premiums into a disadvantage because premiums are known to increase substantially in cases when death becomes more likely. If you are older or in poor health, you will not obtain life insurance at reasonable premiums. The advantages of life insurance are greater than its disadvantages. For instance, life insurance can be for many functions in estate planning, including the following. 1. Term or whole life insurance can be purchased on an individual to provide funds for the surviving spouse or children when death occurs. 2. Whole life insurance can be purchased to provide income to the parents at retirement. This can occur by converting the policy to an annuity or by withdrawing the cash value. 3. Life insurance can provide dollars that can be passed as an inheritance to equalize your estate. 4. Life insurance can be used to provide funds for the payment of estate taxes, estate settlement costs, or debt obligations of the deceased. 5. Insurance can be purchased by the farming heir or heirs on their farming parents. It will provide income at the time of the parent's death for the buyout of land, machinery, or operating assets from their heirs, if the parents have distributed their farm assets equally among all their children. A critical aspect in this example is that the farm or business heir owns the policy and makes all their premium payments. The farming parent or parents are the insured. The policy beneficiaries are the farm or business heirs. Using this format will ensure the death benefits go to the intended people. 6. Farming partners often buy insurance on each other. This process provides funds for buying out the deceased partner's assets if a premature death occurs. The result is that it enables the living partner to keep the farm or business intact. 7. Life insurance can be used to create or enhance an estate. It can be an estate building plan providing money to heirs. 8. There are some life insurance choices that enable people to draw on the death benefit to cover long-term healthcare costs. This can be beneficial for someone who may not qualify for long-term care insurance, but would qualify for life insurance. Ownership of the policy is sometimes treated lightly, but it is an important consideration, particularly in large estates. Generally, death benefits from life insurance are included in the estate of the owner of the policy, regardless of who is paying the insurance premium or who is named beneficiary. A change in ownership of a life insurance policy is a complex matter. One should review ownership provisions with an expert estate planner or insurance agent. Beneficiaries are the people who will get the death benefit proceeds of your life insurance. If your estate is the beneficiary of your life insurance, the plan established in your will or trust determines the distribution of death benefits. A potential problem with this strategy is the insurance death benefit amount can increase the estate to a value above the applicable exclusion exemption amount for state and/or federal estate taxes. That causes an estate tax problem. This issue can be avoided if you place the life insurance in an irrevocable life insurance trust, ILIT. The trust owns the policy, but you are the insured. Because you do not own it, the death benefit is not included in your estate value, but you have the protection of the insurance. This is a complex area, so consult your attorney and insurance agent. 1. The entire amount of the benefit paid out to your beneficiaries or estate is included in your gross estate value for estate tax purposes if you are the owner of the policy. You could inadvertently create a taxable estate through purchasing life insurance if you do not realize the benefit amount will be included in your estate at death. 2. Life insurance proceeds paid to beneficiaries are not considered income to them for tax purposes. An irrevocable life insurance trust, ILIT, can be of use in two ways. First, to avoid having to include the death benefit amount of a life insurance policy you own in your estate net worth, the insurance policy can be placed into an ILIT. The trust owns the policy, and therefore the value is not included in your estate value. Second, if your business entity purchases life insurance for the owners/operators of the entity, the insurance can also be placed into an ILIT. That prevents an individual who chooses to leave the entity from taking some of the insurance cash value with them. The ILIT preserves the insurance intact for those who remain in the entity. There are rules that need to be followed. The ILIT must be properly titled. The ILIT must have its own checking account, and the address on the policy must be that of the trustee. If you own a whole or universal life insurance policy purchased several years ago, it would be advisable to contact your insurance agent and request an in-force illustration to confirm the current value of your life insurance benefits. This process will help you assess how long the insurance policy will remain in force. Is it going to be available at your death, or has the cash value declined to a point where the insurance lapses? This is a critical issue if the insurance was purchased a number of years ago and is a key part of your estate plan. Life insurance plays a vital role in estate planning. It is important to coordinate all aspects of life insurance with your overall estate plan. Carefully analyze all factors before purchasing life insurance. Depending on family and circumstances, term life insurance might be more appropriate than whole life insurance, and vice versa. In conclusion, I strongly recommend for you to continue to evaluate your life insurance as family, estate, and business needs change throughout your lifetime. I have shared different ways in which business owners can create a family business legacy plan that is fair and equitable, depending on their values, priorities, and family circumstances.